The contrarian investor Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." Hello, I'm Christopher Val, CFO at Boyd Industries and also a CPA with a Q4 2020 tax strategy that you might find interesting.
But the economy's terrible. I'm looking at a potentially unprofitable 2020.
Well, it won't always be this way. 2021 is forecasting to be possibly a banner year.
Maybe, but there's a potential loss in 2020.
Well, maybe I could help with that. What if I were to tell you that it's possible to convert your tax loss into cash pretty quickly? Would you be interested?
Maybe.
So here's an example of the concept that we're discussing today. I've prepared an M1 schedule, which is on virtually all corporate, partnership, and S-Corp tax returns. And the M1 simply reconciles book income or loss to tax income or loss. In this particular case, I've added expenses that are not tax deductible, and I'm subtracting income that's not taxable. So it started as a $34,000 book loss, is now a $25,000 tax loss. That tax loss, or net operating loss, can now be retroactively refunded by applying it against income from the last 5 years. That $25,000 tax loss at these tax rates would generate a $6,750 tax refund. Our concept, purchasing capital equipment in Q4 of 2020 and then immediately expensing it using bonus depreciation, or Section 168 of $50,000, creates a $75,000 net operating loss. Carrying that amount back to the 5 prior years of income creates a $20,000 250 cash refund. By purchasing equipment and immediately expensing it added $13,500 of cash back into the pockets of the business owner.
But I have no cash and it's not the best time right now.
Oh, but on the contrary, you don't need cash with this concept, and frankly, the timing is ideal. Why? Interest rates, they're at historic lows.
So how do I justify the debt?
Well, you'll have to calculate your own return on investment, but consider these thoughts. If you think about the return or benefits of new equipment, such as increased capacity, durability, which means and correlates back to predictability, workflow efficiency, patient and staff safety, and frankly, overall patient satisfaction. All those benefits you would have to consider and quantify and compare that to your cost, and only you can do that.
But what if I don't qualify?
I understand, but remember, banks want to finance. They want to lend you money. They're frankly in the business of lending money. In today's market, there's multiple options for financing, from lenders with exceptional options from low interest rates to longer terms, to our own Boyd in-house financing and our favorable credit terms. When you purchase capital equipment and reap the benefits of it and finance it with low interest rates, it's a win-win for all parties.
Shouldn't we wait? Why now?
Why now? Simple. Today you should be preparing for future growth. This industry, our industry, may be experiencing contraction in 2020 and 2021, which means opportunity or new patience for those providers prepared to absorb that market share. And consider that there's built up demand, not only for deferred maintenance, but also deferred invasive procedures. And ideally, this is when you prepare. When volumes are low, it creates the least impact to our patients.
So what you're saying is I have a choice. I can either do nothing and survive, or I can thrive by preparing to absorb growth. And I can do that through expanding or upgrading my delivery equipment. I like to expense the cost, therefore creating a larger 2020 NOL to increase my cash refunds, all through bank financing. And with rates historically low right now, when you put it that way, 2020 doesn't sound so bad.
Exactly. Warren Buffett had it right. Be fearful when others are greedy, and greedy when others are fearful.